Welcome to Gold Silver Pros.
Hey everybody, this is Rob Kientz with 𝘎𝙐𝙇𝙄𝙊𝙍𝙍.com, and this is the weekly market wrap-up for Tuesday, the 2nd of January, 2024. We're in a new year. I think it's going to be a turbulent year. We talked about that last week in our review and preview episode last week. In this week's weekly market wrap-up, we're going to talk about economic data. There's not a lot to talk about, it being a holiday week. Then we're going to go straight into what's going on in gold and silver and what's keeping the price down. Gold and silver price should be much higher, in my opinion, than they are. And then we're going to go into analyze gold silver market. And then I'm going to go into a couple of stories I think that are very interesting that you guys probably are already following. If you're not, I think they'd be interesting for you. So looking at the economic data, not a lot has changed. The S&P Case-Shiller Home Price Index is like a 20-city measure of home price direction in the U.S. Came out last week, and prices were up 4.9%. That's more than the 3.9% increase for last month. A little bit lower than the forecast of 5%. So they were expecting much higher home prices. Home prices are still continuing to climb, and it's a lot. And it's and I basically think it's inflation driving the cost of homes up. But in addition, a lot of immigration we're getting also is going to put pressure on rents and homes as well, probably thereby creating a false sense of security in the housing market until it's ready basically to collapse, because a lot of the other housing indicators are going down. Existing home sales keep being revised down. Existing home sales are down from where they were at their peak. Prices are starting to get soft in some areas. We have too much inventory of certain types of real estate. The commercial real estate market has already started to bust. Residential, I think, is right after that. But for the time period, given money creation and physical demand, housing prices are still going up at the moment. Initial jobless claims are up 218,000 this month, about 12,000 more than we had last month. The trade balance continues to go negatively for the United States. It's now $90.3 billion deficit every month of what we're buying more than what we're selling. And the weakening dollar is not really helping that equation too much for it to be in the wrong direction. It'll be that way as long as we have the dollar, because as long as the dollar is world reserve currency or anything resembling it, we're going to buy more than we sell, and we're not going to be a manufacturing nation. I think that will change. Pending home sales are flat. The Chicago Business Barometer was down, so it wasn't good in terms of the business conditions in the business market. Overall, again, light week in the economic data. So we're going to move on over to gold and silver, where we're going to go over the CME Group's charts like we always do every week. And I know this gets a little bit boring, but it does give us an idea of what's going on in the gold market. And the more times that I do this, the more people that will come in to the show and understand how the market works. So you can see here, relatively light trading going on in gold. Right now, the dominant month is February. It's no longer December, because we're out of December. We're into January. February is the next big trading month. We did see some good sized deliveries on the market, as I'll show you here in a moment. And December was pivotal for the price because we had gold closing above 2,000. We had gold reach another new all-time high before it was smashed down. And I did predict that there would be a lot of physical deliveries and there would be a big spike in the price of gold. It happened. And gold, while it is not sitting at all-time highs right now, it's still doing really well overall. I think at the time I'm recording this, it's trading at $2,058.20, about 2:30 in the afternoon here. Silver's at $23.74. Silver hasn't quite had that pop, but I don't think it will until gold reestablishes and stays at that new all-time high in the 2100 range. Was it 2160 or somewhere that it got to last time on that candle at the open a few weeks ago? So I think silver will challenge 25 and maybe back closer to 30 after gold has sat on a new all-time high and closed that way, either at weekend on a Friday or for several days, in some signal that the gold market's going to stay there. And I'll show you in a minute why that's not the case. In any case, lots of trades going on for February. We're starting to see some frothiness in April. It's a futures market. That's normal. EFPs are still elevated, 1,745 for data through 9:30 this morning. 1,745 EFPs. If you go back to previous data, 1,307. On Wednesday's data, 2257. All this number means is that people are fishing for rate of return over in the London market, and they're trading a US position for a UK position in the gold market. Just means there are price differences. Sometimes they're looking for the metal. but it's an indication that either the pricing is not advantageous on the American market, it's lower than it should be, or there's not enough physical availability, and we don't know, but it's usually one of those two things based on the way that EFP mechanism works. That's why we follow it. Looking at the February data here, as of 1:32 this afternoon, we had 143,000 volume trade, up about $1.60, averaging 2073.40 settlement. The last settlements were at 2070, but we've got some at 2073.40. So a little bit of support in the gold price. Looking at last week, it ended up down 1170 on Friday. We always have those smash downs. I'll show you why that occurred in a minute. Also smashed down on Thursday about 940, but we're calling it smash downs, really small movements, because on Wednesday we had a move up of $23. Tuesday we had a move up of about $1 on the trades. So we're really looking at a fairly robust market in gold in the last week. Okay, so here's basically what you're seeing in the gold market overall. We're going to go over here to the gold ETFs and funds and just look at those. There has been, some movement of gold out. And whenever I show this chart, this is over most of the places gold is held in the Western world. You've got a lot of UK and US based places. There are some other, like Africa and other places here, but this represents mostly the Western world gold depositories where there's a big chunk of gold where we know where it is. It may not be free for trading, could be owned for some specific purpose, but these are repositories. And we've seen about 500,000 ounces come out over the last 4 weeks. This is a 4-week rolling chart that I show once a week. And for the most part, golds have been coming out for almost 3 years here. Almost exactly 3 years, gold's been coming out. Now, you can still see there's a big stockpile, certainly more than there was during the tech crisis, more than there was during the financial crisis. But you can see what happens when you have a financial crisis and gold price goes up, the gold starts to be taken out. So gold will go up and the physical trade gets interested. And then as gold price comes down, certainly in 2016, we hit a bottom. That's when the physical storage went back up, because when gold's not doing well, it's not traded as much, it's put into storage. And then it builds up, and the time when the world needs it, people start taking it out of the system, much like we saw before. And that's been the trend in gold. But overall, fairly healthy gold inventories overall. If you look on the COMEX, if you look on the ETFs. So if you need gold, gold's going to be there until we have a big run, and then that's going to drag the price up. But overall, that gold trade is very solid. And we're going to look at silver real quick, and then we're going to go to commitment to traders. Silver, I'm going to do much more on because, sorry, as I move things around, because there's some interesting data going on at the ETF level, in particular with 2 ETFs in silver, which I wanted to highlight. As we look at silver, as of early this morning, you had some good volume this morning, 50,000 contracts, mostly traded in March. It's the dominant month, not February like gold. Other than December, gold and silver trade on different dominant months. And dominant months are where you're going to have a lot of contracts focusing, because it's a futures market. So the futures are trade heavy about 6 times a year, and gold and silver, they're usually different months with the exception of December. And so in this case, it's March. You've got the silver trade. The last big daily close had 110,000 contracts closing. There's some EFP action over to London, although not as heavy on silver, more in terms of total ounces, because silver contracts are 5,000 ounce versus 100 ounce for gold. But overall, in terms of a percentage of the trade overall, there's less EFP going on silver. That means that silver is liquid enough that there isn't a big price discrepancy between the UK and the US that will cause people to switch contracts. And there seems to be enough physical availability on the COMEX at the moment that they're not an immediate shortage. So those EFPs are, they're strong, but it's not looking at it going, holy cow, people are in a rush to physical silver. We haven't had that big industrial rush to physical silver just yet. Now there's been, and I'll show you in a minute how silver's come off the exchanges, and there's been a steady offtake of silver, but there hadn't been that big rush in yet. Again, silver trading in March. We went back a day and we're looking at last Thursday's data. You see total volume of 35,000 contracts. So overall, a healthy trade in silver, not huge. As of data at 1:32 p.m. today, we got silver trading down about 13 cents on that March contract. If we go back and look at Friday's data, Monday being a holiday, won't have it. Friday's data down almost 30 cents. On really light volume, 2,100 contracts. That's, oh, I'm sorry, 46,000 in March. Contracts is still fairly light, but it's in the holiday season, so understood. 35,000 contracts traded last Thursday. So again, last week was not a big one for the derivative markets, but there was some things happening. We'll get to that in a moment. We'll get to the commitment trader, but I want to go to silver deposits. You see a lot of green here on the 4-week chart on silver. This is silver and COMEX and silver on the ETFs, the big depositories that we know about in the Western world. A lot of silver came into the COMEX the last 4 weeks, almost 10 million ounces into eligible. Eligible is private storage. It's not the liquid part of silver. It could become liquid. You have to designate it as registered in this category to make it liquid, to make it redeemable on a contract. So this category right here is it's just stored in the warehouse. It's a COMEX approved depository, but we haven't put it on COMEX to exchange just yet. Could come out. Some of it could be private storage earmarked for something else. But in any case, a lot of silver has come into COMEX, about 10 million ounces the last 4 weeks, and about an equal number, because if you take this number, the total for all of these depositories minus the COMEX number, you get almost another 10 million. In fact, you do get 10,200,000 have come into the worldwide ETFs. Most of them in ZSIL, or the ZKB is the name. I'm going to show you that here in a minute. Some into iShares. You've seen about 4 million ounces move into iShares, and about 2 million into the SVR SSLN. Let's look at the ZSIL. This is the chart. You saw a big run up at the end of the year through December, early part of December, and then it fell off. So a lot of investment in December, and then some of it fell off, but that has buoyed over the last 4 weeks. This is going to be where a lot of the silver came in, right here. From here to here, on that 4-week chart, we've had some redemptions, but overall, net, a lot of silver coming into the ZSIL. And this is a smaller fund. It's Swiss fund, but it's gotten a lot of activity the last couple of months consecutively. So something's going on with the Swiss silver trade, because I've noticed a lot of ETF flows into ZSIL, people investing in ZSIL as their ETF of choice, this Swiss fund. And there's something going on in Europe and in Scandinavia over there right now, Northern Europe, where people are wanting access to an absolute ton of silver. Is this the Chinese coming in and pulling silver through an ETF? Is this the Western world, Western investors, retail investors? Typically, I'd say this is the retail trade, but looking at the flow, when you look at what's just coming in, 5 million ounces out of 99 total, that's 5% in the last 4 weeks. And the previous 4 weeks, I called out on the program, was strong too. So there's something about this fund is attracting a lot of silver into it. The SLV, the big one here, and that most retail investors know about, the big boy, the one you can't really redeem it unless you're an authorized participant with 50,000 shares. This one's gotten some really big inflows at times in December, but then daily outflows. So this one's actually had really big inflow days and a bunch of smaller outflow days. It's slightly up from where it was, but not demonstrably up. So if we go back and look on the charts on the last 4 weeks, it's been up almost 4 million ounces. But if you go back further than that, there's been some redemptions. This is a big day, and this is a big day that's going to show up on that 4-week chart. This is the big one, 167 million in one day. But we've had some pull-offs. So overall, if you go and look at that SLV chart, we'll click on it. Whoops. We'll click on it right there. And it's going to change the chart down here. It hasn't really ticked up. There's still been a net flow off. Even though you see these 4 million ounces the last 4 weeks, when we click here and look on the SLV chart, it's still been flowing off. So don't let the recent flows fool you into understanding what's actually going on with the ETFs. There has been some silver and gold come back into the ETFs, but it is in no way, shape, or form really affected the amount that has been outflowing the last 3 years. So a mini trend of some flow back in to the COMEX and to these ETFs, but it's a mini trend only. It's not a big sustained trend. Now we're going to get over into the commitment of traders. I want to talk about the shorting that's going on by the banks. So this is as of December 26th. It's the latest data. I'm open live on their website, ctfc.gov. And this is what they have available. Pretty soon we'll get another one. They're about a week to 10 days behind typically. They collect the data from their traders. They aggregate it. They don't have direct feeds into all the systems. We know about that from reading the website and during the cyber breach that they had last year. In any case, so they collect the data. It comes out behind all the other data. So what we're looking at here is a trade through December 26th at 7 to 10 days. And the swap dealers are sitting at 45,585 short silver contracts. This is silver. So this entire chart here is silver, this section. I'll move on to gold in a minute, but draw a mental box around this. This is silver, and I'll scroll down and we'll draw a mental box around gold in a minute. But the swap dealers, I call the swamp dealers, the 4 and 8 largest banks that have the highest concentrated short position. How do we know? Because down here in the aggregate numbers for these tables, all traders 4 or less short, 37%, 8 or less traders, 53% of the shorts. So the shorts are aggregated in the 4 and 8 traders. Well, you're going to have shorts in the producers because they're always protecting against downward price movements for something they sell. So they're going to have 41,000 contracts short. That's legitimate hedging. They produce it. So they're making plans. What if silver goes up to 25? What if it goes down to 18? So they're making plans on their mine plans. They have to make months ahead of time. So the way that this market was originally introduced was for the hedgers. They'll get in and say, okay, I'm worried about silver price falling from 24 bucks to 22. While I'm mining it, that could take and refining, that could take 2 to 3 months, and transporting and all of our mine plans. So we may have, a $10 million potential loss if silver's at 24 now, but it goes down to 22. So, and we're making our plans now at 24, but if it goes down to 22, we may make a lot less and lose money on that trade. So what they do is they come into the derivative markets and they'll take a short position. So that if silver does go down from 24 to 22 or 24 to 23, they make money on that trade to offset their loss of the actual physical product. That's hedging. So I expect them to have a heavy short position because it's legitimate heavy shorting for the purpose of the market to offset their physical exposure because they're dealing with the physical product. The swamp dealers don't produce the physical product. Now they can trade on behalf of producers and merchants and other entities, but if the producers and merchants have their own accounts, how many of these entities are actually being represented by the banks? I've always said it's a lot less than people think. And I think the swap dealers are more representing sovereigns, large traders, and their own book in this trade. And they're sitting not quite a 2-to-1 ratio short to long of silver. But remember about a month ago where this were almost dead even to where the bullion banks had about the same amount of longs and shorts in silver. And now there's almost 16,000, 15,600 more short contracts than long. And just in the past week, or at least leading up to December 26th, they added almost 2,000 shorts and dropped almost 1,000 longs. That's 2,900 movement to the short side in silver net on both sides of that trade. And the people on the other side are going to be the managed money, some of the producer merchants, some of the other reportables. And the swap dealers are the concentrated short, and that's what's holding the silver price down. Those are just facts looking at this document you cannot argue with, period. Now we're going to look at gold. Let's build our mental box around gold. Here's the box that we build around gold. Here's the table. Same table as silver. Don't let it bother you. I'll highlight the swap dealers and I'll highlight producer merchants. Producer merchants, for the same reason in silver, go short in gold to protect against downside price risks. Now, the merchants want the price to fall. So they're probably the ones that have the long position because they want the price to fall. Because if the price falls, that means the silver or gold they're using in their process, gold, usually it's building computer main boards, soldering, contacts, jewelry, things like that. If the price falls, that's better for merchants. It's cheaper for them to get it. So they're probably the long side. The producers are short because they're worried about the price falling. They're going to get less for it when they sell it to the merchants. So they pretty much have the short position. Why producer merchants aren't broken into separate groups so we can really see what they're doing, because they have diametrically opposed viewpoints on the market, on the pricing of the market. Why they're put together, I just think creates confusion. Because as a producer and a merchant, you're going to take opposite positions. Merchants want cheaper prices on commodities. Producers want more expensive ones. So all this does on the CFTC's report is muddy the waters. They need to break this category out into producers and into merchants. And they need to get swap dealers or the bullion banks to break out their house positions, their client positions, and break out their client positions by industry so that we can see who they're really representing. Because right now in gold, they have 261,000 short contracts and only 74,000 longs. That's over a 3-to-1 ratio in gold of more shorts than longs. And again, if you want to look at concentrated percent of open interest held by the number of largest traders in gold, the 4 traders have a third of the market short, and the top 8 traders 50.9, and it's mostly sitting here in this category. We also know that from seeing the Office of the Comptroller of the Currency report, which banks those are, and I've called it out on the program several times. It's Bank of America and 3 other banks, Citigroup. We know who they are because they're called out in the Office of the Comptroller of the Currency report. And their derivative positions are even breaking out gold into a separate position. So you can see who it is. It's the bullion banks. That's what we call them, the swap dealers or the swamp dealers. They're the ones shorting, and they added 7,600 contracts to the short at drop longs. And who's taking the opposite side of that trade? The managed money was not doing the same thing. They're dropping shorts. You had the other reportables, the wealthy family offices and individuals going really long, expecting gold to go long. So the shorting or the price, keeping the price down at the end of the year and into the new year, and all of that shorting that went on when we had that spike a couple of weeks ago, gold to a new all-time high, is done by this category right here. And according to the Office of the Comptroller of the Currency, there are 4 main banks that do it. We know who they are, and then a few others. And they're the ones that are really controlling the top side of that price in gold and silver. It's just facts. It's just data. I don't know how else to say it. It's data. What do you want me to say? All right. Stories of the week. I've been harping on that for so long. Let's get to stories of the week. We're sitting here at 21 minutes. I want to talk about the banks. The banks really should be the focus of our viewpoint, both on the commodities markets for their positioning in the commodities markets, but also on their own books. So yes, we know that they move around the commodities markets in whatever way that they want, ostensibly to make money on their positions, either held for themselves or for other people, through both the futures and the options markets, and maybe over in London and other markets as well. But now we want to look outside the commodities and look at their books. And according to Wolf Street and the source FDIC, and I've validated this at the FDIC, I'll show you an FDIC chart here in a moment. It has some additional data. But these are the unrealized gains and losses on securities at commercial banks. So these are the securities that commercial banks hold, and they're net either unrealized gain or unrealized loss. Why unrealized? Because they haven't sold it. So let's say you own a piece of real estate. You bought it 5 years ago, and you haven't sold it yet, but you think it's gone up 32%. What is your unrealized gain because you haven't sold it and taken that money off the table? 32% more than what you put down, right? Well, an unrealized loss goes the other direction. Let's say you hold a bond, and because of higher interest rates, that bond face value has come down, and you're marking to face value in the market, and you're like, my bond is worth 8% less on face value across this bond portfolio. That's an unrealized loss. You haven't sold that bond. You're still getting maybe the coupon payments for the interest rate. So you can still say it's cash flow positive. But if you're turning around and sell that, it's worth a lot less. That affects the solvency of your organization because it's an asset. And right now, the banks since 2021 have just been, the losses have been astounding, as you can see on this chart. And not only that, but they lost $1 trillion in commercial deposits in 2023. They lost $1 trillion in commercial deposits. Why is that important on this chart? Because cash is considered an asset, and you can't have a loss on it because it's the actual cash. So there's no unrealized gain or loss on cash. It's just a straight asset. So it has one of the least risks in the system. As long as the dollar is solvent as a currency, it has one of the least risks in the system because you can use it to pay down debt, to buy stuff, to buy stock back, to pay bills. So they lost $1 trillion that they could use to put out in the market and offset some of these losses, or to buy out some of these losses and sell off some of this debt and use your cash reserves to say, to make up the difference. Well, they've lost $1 trillion in cash reserves. So losing $1 trillion in cash reserves is like over a third of their reserves. How are they now going to deal with all these unrealized losses on the books? We're setting up for a big time bank failure here in the United States. Well, let's look at the FDIC 90 website, fdic.gov. I've shown these charts before, but I wanted to show it again. These are bank failures, and you'll see in the 2008 to 2011 timeframe, we peaked at 157 failures that year in 2010, and then came down. So even though the crisis is 2008 to 2009, actually 2007 to 2009, if we're really being honest, because the crisis started before the mainstream media noted it in 2008, and Lehman crisis really started in 2008. The crisis in the mortgage and real estate market started in 2006, 2007, and you can see that's where the bank failure started. Look at what happened at the peak. A couple of years after the peak, February 2009 was the absolute worst day. February 1st, 2009 was the worst day in the market in the Great Recession by all metrics. Also the only time I ever got laid off from a job on that same day, that's why I remember it, and I've looked at the data, in February 1st, 2009 was the absolute bottom of the Great Recession. But it took a year and a half later before these bank failures started being alleviated. And that was through creation of government programs, bailouts, but also things take time to fail and it reverberates throughout the system. So once the failures start, they don't stop. Why am I bringing that up? Because fast forward to 2023 and 2022, where we started having these bank failures. Which bank failures do we have? I'm going to show you here in a minute on a chart by Visual Capitalist. We had these big bank failures: SVP, Signature Bank, was it First Republic? And there were 2, 3, and 4 on the charts. Biggest all-time bank failures. And they happened at one time. But remember what happened during the Great Recession. We had some bank failures and they kept going and they kept going. So these aren't going to be the only bank, this is why I show you this chart. These aren't going to be the only bank failures we see. We will see more. But what's interesting is the first spigot or segment or chunk of bank failures we had this past year caused more losses, 548 billion to 373 billion, than was realized during the height of the losses of the Great Recession. And in fact, if you look at the worst 2 years of the Great Recession, you're sitting at about $543 billion, $544.4 billion, 548 in the first year of this one. So in this one, I think in terms of frequency, length, duration, and overall amount of damage is going to be much, much, much bigger than what we saw during the Great Recession, 2008, and the bank failures all the way through 2011, even 2012. And it wasn't really till 2013 when you started seeing anywhere near a normal number, actually 2017, when a near normal number of banks failed. And what all this led to is consolidation of the banking industry. And now we have more branches serviced by lesser amount of unique and independent banks. So 2008 Great Recession was a bank consolidation, and 2023 was another bank consolidation. And so these banks are getting bigger with more risk. And eventually, I think that will lead to insolvency of the larger banking system in the United States. That's the clear trend there. Looking at Visual Capitalist, I love this website, by the way. Visual Capitalist does the best infographics anywhere. You can find an infographic for just about anything. I love you. Thank you so much, Visual Capitalist. This one's on U.S. banking failures. Now, these three were this year: Silicon Valley Bank, First Republic, and Signature. And notice that they dwarfed the biggest one that occurred during the 2008 timeframe. That was WAMU, Washington Mutual, 188 billion. We had one almost as big and then two others. And this one looks to be bigger. This is the damage. This chart down here is a line chart combined with a graphic chart on all the damage that occurred. 2009 being the peak of the problems. You had the two bigger banks failing during that time. But then after, look at the runoff, a number of years of banking damage done, years and years of banking damage done down here, even after the Lehman event. And we've already had more failures this year, and we haven't gotten to the worst part of this recession. They're not even calling it a recession yet. So what are the odds that it's not 5 times worse, 10 times worse than last time when this happened during the peak of it? And this happened before they're even calling a recession, and everybody thinking, oh, everything's good. You can just tell looking at all these charts how much bigger it's going to be this time. Look at this. Look at the insolvency of the banking system. This is all commercial banks. And Bank of America, I was reading an article, Bank of America's 131 billion of this. And that's just what we know about, what they've reported, not what's actually sitting on their books. That's one bank. One bank, Bank of America, has a third of all the bad mortgage and treasury debt that's known to be bad right now. One bank. They're dead man walking during the next recession. The government's probably going to try to bail them out, but they're a big bad boy and they're in bad shape. And then just look at what's happened earlier this year. They papered it over. They did the bank fund program, lending program, BPFB, which papered over some of the losses but didn't stop it. It's going to be worse. And you can see already it's been worse this year, and we're not officially even into it. All right, moving on. Last point of the show. We are now 29 minutes in. We're going to get this wrapped up in the next 5. I asked a Twitter poll, and on this poll I said, what's the most surprising event or series of events of 2023 for you? And I put wars or other conflicts, any type of conflict. It could be at home or abroad, but just generally nasty sort of conflicts that are violent and not happy, gold reaching new highs, bank collapses, or other. Over a third of you said wars and conflicts. And the reason I'm bringing this poll up is that means that people didn't expect to have wars. Over a third of people did not expect to have wars or these types of hot conflicts going on in the world. They expected gold potentially reaching an all-time high. They expected some bank collapses. But the most surprising single thing has been the wars. And the reason I bring that up, and we're going to come off share for the rest of the video. The reason I bring that up is because essentially war goes along with a lot of this financial stuff and cultural stuff and political stuff that we're seeing. And I've talked about it and talked about it. The wars are probably going to expand. It's going to put pressure on the system. It may be the black swan that breaks the system, that eventually breaks the banks and the commodities market, or the wars. Because what do you need during wars? You need commodity usage. What are the banks handing out? Debt and money. What's going to pay it back? Do we have our 8,000 tons of gold? Is it going to be on the people to pay back hundreds of trillions of dollars, whatever it's going to be between the war machine and the unfunded liabilities? It seems to me the world is spiraling towards a inflection point. All three legs of the stool, culturally, politically, economically, and they're going to happen at about the same time. So moving forward, I would say if you watch my channel, probably don't be as surprised as much by the wars that are coming. Those are going to increase. That's been history. I don't like saying that, but that's been history. And if you study history, you know kind of how this playbook goes. Human behavior repeats. It just does. It's cyclical. Sorry to say it. We hope it doesn't. I'm hoping and praying the violence doesn't. I hate violence of any type. Hate. But that is going to exacerbate the system. And when you look at the banking system and you look at all of those things, certainly my call at 2024 is going to be turbulence, probably a pretty good one. We'll see how turbulent, if I'm right or wrong. I would love for it not to be. If we go back to, leave it to Cleaver type of lifestyle that everybody had in the 60s would be wonderful. Of course, we know that's not going to happen. Something's going to happen before we can get back to that, but we'll navigate it on the program. We'll let you guys know. I wanted to take a moment to shout out to people. Thank you for watching the program and supporting me. This past year, we had a change on the channel, a change venues. As you can see, I now have my own store. We built that over the summer and we debuted it in September. Thank you to the people that are making orders and supporting that store. There are a lot of regulars that both come by physically and order online, and thank you so much for doing that. This pays for me to be able to continue to do YouTube for you. I needed to have a way to do it. Else I got to go get a full-time job and I don't have the time to do all this research. So those bullion sales are helping. Thank you so much. We'll announce another sale at the end of this week. I'm trying to figure out what I want to do. Probably go back to silver. Just the retail report for you guys. Gold's been the biggest seller over the last month and a half. Silver sales have really fallen. I suspect that's because people are waiting on gold to pop first before silver. And silver usually goes after gold. And the crisis of all the things that we're seeing in the world is leading people to gold, which is the ultimate monetary hedge. Certainly, the central bank digital currency system in Basel III is pushing the big banks towards gold. So that's been the emphasis. People will get back into silver. And I did have a silver poll up on the program asking, what do you think silver price will be? And I think I made the call, $35 silver sometime at end of third quarter before the election. That's a big call. That's 11-ish more bucks than it's trading at right now. It's rare for silver to do that. The implications are gold would have had to go first. So if we start seeing more bank failures this year, another hot war start, more pressure in the system, more risk in the system, more news about de-dollarization, all of those things is marching forward. And heading into this recession on an official level, instead of us just knowing we're in one, but the government actually saying it, I think that pushes people into gold. And you can see by the way the banks are treating gold, they're trying to hold it down. But gold popped a couple of weeks ago, and it's going to continue to do that. And we're in that bull market, and gold's going to push through those glass ceilings of that derivative trade that they're trying to range trade it and hold it. And if gold stays above its last all-time high, was it 2060 or whatever it was a couple of weeks ago, it was on a candle and it came right back down. So there's always debate when that happens. It didn't close, at 2160 or whatever, but it hit up in that range. So if gold trades and stays there for any length of time, silver goes. I mean, it just pop, boom. Because people are going to say, well, if gold's doing it, silver's going to do it. I'm going to go into silver, and silver will move more violently, more quickly through 30. Now, we may not get 35 silver in 2024, and that means that we haven't had a bunch of big banks blow up. Some of the Middle Eastern and Ukrainian conflict has come to a resolution or died down. Somehow the American economy is still limping along, even though everybody's indebted up to their eyeballs. If they can continue to, in this election year, control the markets enough to where they don't just start breaking apart, in an earthquake scenario, then maybe we don't see that. But I suspect in 2024, some of that starts to happen. That was my call. We'll see what happens. I could be totally wrong. I made calls on precious metals before. I'm totally wrong. That's why I usually don't do it. But I do suspect prices will be much higher for gold and silver this year on an average throughout the year because of all, the issues that we've talked about. All right. That's going to do it for today. Stay tuned to Thursday. We'll have something on sale for sure. Thanks to all those people that took advantage of the Crew Grand Sale, the Bar Sale, the Maple Sale, the Eagle Sale, all of the sales we've had this year. 2024 overall for the shop. I have more wholesalers, more suppliers, so I can get you more competitive pricing on everything. I'll say it again. If you need $10 or $20 million, I can get you 10 or 20. I have a guy that saves $150 a month in silver, and I'll pick something out to send him. And it doesn't matter what level you're at, but I can handle volume and flow much, big levels if we need to. I've got those sources. So don't worry about that. Some exciting announcements will come on our channel this year. I'm already working on some additional business development for Gold Silver Pros. So not only are we big social media concern, not only will we be a retail outlet, we'll have some other things going for us as well as we continue to march Gold Silver Pros name along, march the business along. And again, that's all because of you guys. So thank you so much for supporting the channel. This is going to do it for this week's weekly market wrap. Thursday, I'm not going to tell you what I'm going to do because I haven't decided, but I've got so many things to talk about. I've got some really good ideas. In fact, I'm going to talk about some of the positivity things going on. I talk a lot of times about these sort of black swan type of stuff. We're going to talk about some positive things that have been going on that have been really encouraging from an economic and a cultural standpoint that I think are going to be great. And then Thursday, we'll have some sort of data for you. I've got so many things to talk about, though, man. So many charts. We'll come up with something good. Thanks for supporting the program. Until next time, Rob Kientz, goldsilverpros.com.